Unlock your 2024 success with these stocks, no matter what the market throws your way. Realty Income. Let's start with Realty Income, a real estate investment trust, or REIT, that's our top pick for dividends. They pay out every month thanks to the cash flowing in from over 13,250 real estate properties. These properties are mainly locked in with long-term net lease agreements. Just a while back, Realty Income shared some good news. They're increasing their monthly cash dividend to $0.2565 per share, up from $0.2560 in the previous round. And it comes with a sweet 5.3% dividend yield. According to RBC Capital analyst Brad Heffern, Realty Income is a standout in the net lease REITs group for 2024. He's impressed by their low cost of capital, which he thinks is super important in the net lease REIT world. He says, "We think O has some of the highest quality net lease portfolios in the space, with an above-average investment grade weighting, a strong industrial portfolio, and a high proportion of tenants with public reporting requirements." Heffern also sees Realty Income as a strong player in mergers and acquisitions, or M&A, especially after recent moves like the Spirit Realty Capital merger. He's a fan, giving Realty Income a buy rating and slightly upping the price target from $58 to $57. In short, Realty Income is a smart choice for dividends, with a solid portfolio and room to grow, according to Heffern, a well-regarded analyst who knows his stuff. Visa. Now let's turn our attention to Visa, a name and logo familiar to millions as one of the world's leading payment network providers. Operating at the forefront of daily transactions, Visa's credit cards are widely used, contributing to the company's revenue, earnings, and cash flow growth over the past decade. Visa's business model has proven successful as people increasingly opt for credit cards over cash and checks. Despite not holding the title of Dividend King, Visa has impressively increased its payouts by 420% in the last 10 years. Looking forward, Visa is likely to sustain its success, given its near duopoly status with MasterCard, a direct competitor. Benefiting from a network effect, Visa's ecosystem becomes more appealing to customers as more merchants join. While some may question further growth opportunities for Visa, especially in a world dominated by credit cards and digital payments, the company sees significant potential in developing countries where economies are expanding and cash and check usage remains prevalent. Although Visa's dividend yield may seem modest at 0.8%, the company's commitment to consistent growth makes it an attractive option. With a robust business model and ongoing opportunities for expansion, Visa appears well-positioned to continue its impressive performance for the foreseeable future. Kraft Heinz. Moving on to Kraft Heinz, or KHC, a prominent player in the packaged food and beverage industry, boasting a diverse portfolio that includes well-known brands like Kraft, Oscar Mayer, and Heinz. Offering a quarterly dividend of 40 cents per share, equivalent to an annualized dividend of $1.60 per share, KHC stock presents an attractive dividend yield of around 4.3%. In a bid to enhance shareholder returns, the company has also introduced a $3 billion share repurchase plan, valid until December 26, 2026. In a recent development, Evercore analyst David Palmer upgraded Kraft Heinz stock from hold to buy, concurrently raising the price target to $42 from $40. Palmer is optimistic about KHC's organic sales trajectory turning positive in 2024. The analyst revised his 2024 EBITDA estimate for Kraft Heinz, citing factors such as stabilized domestic retail sales trends, improved margins driven by productivity efforts, moderating commodity costs, and growth prospects in emerging markets. Palmer highlighted that Kraft stock offers a higher dividend yield compared to its peers and trades at a lower 2024 P/E multiple of 11.5 times, contrasting with the center store food peer average of 13 times its price-to-earnings ratio. Despite a similar balance sheet and higher growth outlook, KHC trades at a lower valuation, making it an appealing choice for potential robust returns. For more expert insights and updates, don't forget to like and subscribe. Coca-Cola. Coca-Cola, KO, secures its spot on the list of dividend kings, boasting decades of consistent dividend growth. With a payout of $1.84 per share and a yield of 3.06%, similar to J&J, it outperforms the S&P 500 in terms of yield. The company's cash dividend payout ratio reveals that it allocates 76% of free cash flow to dividends. The good news is that Coca-Cola's increasing free cash flow suggests the sustainability of this payout strategy. What fuels this growth is Coca-Cola's strong business model, encompassing its iconic beverage and a range of other top brands such as Dasani Water and Minute Maid juices. This diverse portfolio keeps customers coming back. Coca-Cola's robust competitive advantage lies in its brand strength, helping the company maintain earnings growth even in the face of higher inflation affecting consumer purchasing power last year. With this solid brand foundation, you can expect Coca-Cola to consistently increase earnings and dividends, making it a top choice for long-term investment regardless of the economic environment. Johnson & Johnson. As a dividend king, Johnson & Johnson, or J&J, has consistently increased its dividend payment for over 50 consecutive years, underscoring its commitment to rewarding shareholders. In 2021, Johnson & Johnson made a strategic move by splitting its consumer segment from its core business, completing the spin-off of consumer health company Kenvue in August 2023. Despite the change in structure, J&J remains profitable and is expected to grow stronger as it focuses on its core businesses, particularly innovative medicine and medtech. J&J's innovative medicine division has played a crucial role in developing life-changing drugs, generating $41 billion in sales in the first 9 months of 2023. In the third quarter, this segment's sales increased by 5.1% to $13.9 billion, contributing 65% to total revenue. Notable successes include the immunology drug Stelara, with sales increasing by 16.9% year-over-year to $2.8 billion, and the plaque psoriasis treatment Tremfya, which saw a 22.2% increase in sales to $891 million. Additionally, J&J's oncology drugs Darzalex and Erleada added $3.1 billion to total revenue in the third quarter. Overall, total reported sales in Q3 increased by 6.8% year-on-year to $21.4 billion, surpassing expectations. Adjusted earnings per share, or EPS, also saw a substantial increase of 19.3% to $2.66. J&J's commitment to research and development is evident, with R&D expenses accounting for 16.2% of total sales in Q3, totaling $3.44 billion. Looking ahead, J&J aims to expand its medtech segment, which experienced a 10% year-over-year growth to $7.5 billion in Q3. The company has entered the robotic surgery market with its Ottava system, aiming to capitalize on the thriving artificial intelligence market, expected to be worth $18.4 billion by 2027. While Peer Intuitive Surgical, or ISRG, currently dominates the robotic surgery space, J&J's innovative capabilities position it to establish a significant presence in this market in the coming years. As a dividend king, J&J continues its legacy of dividend increases, paying out $4.76 per share with a yield of 2.95%. With over $15 billion in free cash flow, the company is well equipped to support ongoing dividend growth. The strategic spin-off and focus on pharmaceuticals and medtech present a compelling opportunity for investors seeking a combination of dividend stability and future growth. In short, these stocks, Realty Income, Kraft Heinz, Coca-Cola, and Johnson & Johnson, offer solid opportunities for investors in 2024. Whether you are seeking dividends, growth, or stability, these companies have something to offer. Which stock caught your eye? Share your thoughts in the comments below. Don't forget to like and subscribe for more updates to stay informed in the dynamic world of investing. Happy investing!